So we're going to talk about cash today. Well, we keep also talking about recurring clickbaity negative articles in the press about Miami and South Florida. There's one that I saw recently. It was the Wall Street Journal again, of all things, talking about froth and bubbles. They use the word froth, froth, bubbles. They're built on debt. And then when the asset class pops, it's because the underlying asset can no longer sustain the debt load. And we get this sort of apocalyptic steep decline in values.
2008.
Right.
Yeah.
And then in retrospect, we define said phenomena as a bubble after it popped.
Yes.
But you need these conditions. And the pop, the descent needs to be possible. It's a house of cards that folds, basically. So I see these headlines about froth, bubbles, and so forth, and I find them a bit irresponsible because all they do is they mention rising values.
Yes.
But they don't actually dig into the underlying fundamentals of the market. And if they were to do so, they would see that they in no way resemble that last cycle because this market was built upon cash to a shocking degree.
I think Miami has been built on cash since the last cycle.
Correct. Absolutely. And then also, I'm going to point out also that nationwide, there's a very low percentage of people using adjustable rate mortgages, which is also the reverse setup to the previous cycle.
I think that's good.
Correct. And then also nationwide, there's been all this data coming out showing that something like 39, almost 40% of houses are owned outright with no mortgage nationwide.
Yeah.
So there's a real floor on this market at a national level and then on a local level. It is not some crazy debt-fueled thing nationally or here. So there's a real floor on this market at a national level and then on a local level. It is not some crazy debt-fueled thing nationally or here. But when we dig into here, the numbers are really quite shocking. I mean, I broke them up most recently in a report that I did. Everybody could find it in analytics.miami. I did it by county, and then I also did it by price points and by prices per square foot.
Okay.
And prices per square foot is where it gets interesting because, as I keep pointing out, the higher you go in price per square foot, the shockingly more all cash it is. But even starting at very normal levels, so below 500,000, this is South Florida, so aggregate Palm Beach County, Broward County, Miami-Dade County. Below 500,000, single-family homes are 31% cash, and condos are 51% cash.
Okay.
And then that trends up. When we get to 1 million to 5 million, single family was 51% cash, condos 77% cash. 5 million plus, single family 84, condos 88% all cash.
Wow.
Yep. And now if we go on a price per square foot basis, it gets even more interesting. Looking at condos, so for all of South Florida, again, Tri-County, 2,000 and up per square foot is 84% all cash. 1 to 2 is 83. Single family, 88 and 76. Same thing. Palm Beach is leading the way. Palm Beach condos past 2,000 a square foot, 94% all cash. And 1 to 2,000 a square foot, 91% all cash. So the market is heavily cash the whole way through. And the higher up you get, the shockingly higher it is in terms of all cash buying percentages.
I think there might be some bias in there from outsiders that because Miami was so front and center the last thing that, and it was The Big Short, it had it in
all
there.
Of that cocaine cowboys.
Yeah. So I think that the whole everyone that did ninja loans and all of that, I think that was very front and center in Miami. So I think they still think that exists.
They want to think there's still a boom bust phenomena going on.
Yeah.
And I get it. It's a past association, but it's not it. And then, meanwhile, in addition to these high all-cash levels, we have inventory levels that are below pre-COVID across the board to varying degrees, depending how you segment, but across the board, below COVID.
Yeah.
So this is not a bubble setup at all.
Interesting.
And now, if anything, because the segments of the market that had the lowest all-cash usage were single-family below $1 million. Okay. So if anything, this decrease in the interest rates will help that segment of the market because that segment saw the rapid disappearance of inventory. Single family below the median price point, inventory is down well over 80% Tri-County. So if anything, it'll free up some much needed inventory because the single family home market is extremely tight. So it might actually help that market segment.
Yeah, and also with the Fed starting to cut rates, that'll probably help as well.
That's what I mean. Yeah, correct. Yeah, exactly. So it's a good thing. It's a great thing. And again, the high end, 80-90% all cash. This rise in our market was fueled by cash, not debt. That is the very, very important distinction to make from this time and last time. Inventory levels actually have not kept up with the increases of demand.